Governments don't go bankrupt. They are far too clever for that. Bankruptcy is for the honest borrower who admits they have run out of road. Governments don't admit failure. They simply change what money is worth. And once you understand that, you start to see inflation very differently. It isn't a glitch in the system. It's how the system keeps going when it's under pressure. A bit like trying to keep the kettle boiling when the water is already running low. Let's stop pretending this is normal borrowing. This isn't a mortgage or a car loan that gets paid down over time, right? Global government debt is now over 100 trillion US dollars. The US is pushing towards 40 trillion and paying over $1 trillion a year just in interest. Not the debt, just the cost of carrying it. In the UK, interest rate payments are now one of the largest items of public spending. At this level, this stops being a question of accounting and becomes a question of sustainability. So the real question isn't how will this be repaid? It's what will that repayment actually be worth? Historically, governments had 4 ways out of it: growth, austerity, taxation, or inflation. Growth is the cleanest solution. If the economy expands fast enough, that becomes easier to carry, right? But growth like that is rare. It requires productivity gains, strong demographics, long periods of stability. Today, those conditions are weaker. Austerity is politically difficult. Taxation has limits. You can only squeeze so much out of the same lemon before there is nothing left to give. Which leaves the fourth option, inflation. But inflation is widely misunderstood. It's not just prices rising, it's a shift in value. Imagine you lend someone money today. They promise to pay you back in 5 years. The number doesn't change, right? 100 remains 100, but what that money can buy does change. If prices rise sharply over that period, you have effectively been paid back in something far less. On paper, nothing changed. In reality, you've been shortchanged. This is how inflation works. The numbers stay the same, the value changes. And at a system level, this difference matters enormously. Because government debt relies on confidence. Confidence that the currency will hold its value. Confidence that deficits will eventually be contained. If that confidence weakens, you don't get an immediate crisis, but you do get a change in behavior. Investors start demanding higher returns, and they move into real assets like property, infrastructure, commodities, anything that feels more solid than cash sitting in the bank. And here's the critical part. A large portion of government debt is short-term these days, which means it has to be rolled over constantly. Old one matures, new debt must be issued again and again. So kicking the can down the road, hoping the road never ends, the process only works if investors are willing to keep funding it. If they hesitate, the system adjusts. Capital moves, asset prices rise, and holding cash starts to feel less attractive, like sitting on a melting ice. Spending picks up, and over time, that feeds into broader price increases. This is how inflation builds, not just through policy, but through expectations. It's worth noting that inflation can be anticipated into existence. The process is gradual, controlled, almost invisible. But here is where it becomes dangerous, because there are moments when the system loses control of that balance. Moments when inflation is no longer a tool, but a threat for the government. And one of those scenarios is very clear. If oil pushes towards $200 a barrel and government bond yields move above 5%, both simultaneously. Now think about what that means. $200 oil drives inflation sharply higher, right? Energy costs surge, transport becomes more expensive, food follows naturally, everything starts to move. So the central banks are forced to respond. They have to raise interest rates. But yields above 5% don't just slow the economy, they hit government debt quite hard. When debt is already this large, even small increases in yields translate into massive increases in interest costs. So now the system is trapped. Raise rates to fight inflation, and you risk destabilizing the financial system. Cut rates to protect the system, and inflation accelerates. That's the moment the strategy fails, because now there is no good option. That's not a policy anymore. That's a lose-lose. And we have seen something like this before. Late 1970s into the early 80s, after the Iranian Revolution triggered an oil shock, high oil, high inflation, high yields. Back then, central banks forced rates higher and triggered a deep recession to regain control. But here's the difference. Debt levels today are far higher, which means the system is far more sensitive. What was painful then could be far more destabilizing now. And that is the real risk. Not that the governments use inflation, but that they lose control of it. Because once that happens, you no longer have a policy choice. You have a policy constraint. And that's what economists call fiscal dominance, when monetary policy is no longer fully independent, because it has to take government debt into account. And once you reach that point, there are no clean, clear-cut solutions. There is no reset. There is only adjustment. Debt doesn't disappear. It gets diluted slowly over time. And that dilution has a cost, because it doesn't come from nowhere. It shows up in your savings, your purchasing power, your cost of living. Not suddenly though, but gradually. And that's why it doesn't feel like a crisis. It feels like pressure, constant pressure, like the cost of everything creeping up while your money stands still. And that's the real story. Inflation isn't just an economic outcome. It's how the system adapts when there's no easy way out, until it stops adapting and starts breaking. And when that happens, it doesn't look like bankruptcy. It looks like money itself losing credibility. So the question is no longer, will the debt be repaid? It's, what will it be repaid in? Until next time.